Welcome to TheoTrade. This is Don Kaufman doing the weekend update here on May 20th, 2017. We'll get right to it. Well, finally, a little bit of volatility this past week in trading. So the most important question that we're going to try to answer in this weekend update here was the volatility that we just saw, obviously on Wednesday. Is that just a quick flash in the pan? Is that it? Is that all she wrote? Or are we going to trade right back into this normal low volatility range? Or are we likely to see some more significance to the move that obviously started, of course, on Wednesday, and some instability, of course, followed on both Thursday and Friday? So we'll get right to it here. I think one of the first and the most important things to get to initially is something we look at really almost day in and day out, but specifically on the weekend updates, we talk substantially about the SPX and the expected moves on the SPX. So for those of you that are a little bit newer and might not necessarily tune in and day out, what the expected move happens to be based on is options and option pricing inside of the SPX. Now, the reason that we not only look at the SPX, but the SPX carries a tremendous amount of weight in the marketplace is the sheer order flow, the magnitude of trades that go through in the SPX. It literally moves markets. So we watch option pricing, okay, because the option trades themselves in the SPX are hedged, which is a risk mitigation tactic that all the trading firms use. They use what's called dynamic hedging. They use algorithms to hedge their risk. Well, all of those firms, they're always offloading risk that they acquire by trading the SPX. And one of the things that's so important just to recognize, okay, the magnitude of the SPX trade. And here, what I'm showing you is Friday. This is from Friday's trade. It wasn't exactly like, a huge trading session like we had on Wednesday. Nevertheless, options as a whole traded about 22 million contracts on Friday. And you can see almost 2 million of those contracts were SPX. So if an entire marketplace has 22 million contracts traded, okay, the SPX accounted for 1.2 million of that. And initially you look at this and you think, whoopee, right? It's like 1/20th. Yes, but the SPX contract, it's almost a $2,400 product. If you think, if the average stock was $240, which it's not, the average stock is actually smaller than that, but you can see that the SPX is 10 times the size of, for instance, the average stock. But the average stock, even if the average stock was $120 stock, the SPX is still carrying what? 20 times that size. So then you start to realize 1.2 million contracts being done in the SPX, okay? It accounts for, if you think about what's termed notional value, the amount of liquidity moving, it accounts for the vast amount of capital moving of 22 million contracts. So the number of contracts isn't that important. It's what the contract size happens to be. So 1.2 million contracts, I mean, that's massive. And then you also realize that, so the SPX does 1.2 million, then you go over to the spiders. And if you're not familiar with the spiders, well, okay, the spiders, again, what do? They kind of mirror the SPX. It's a little brother to the SPX. We'll scroll down to the bottom of the screen. You realize, what? The spiders do 4.5 million contracts. So now we have two products, okay, that are related, ultimately joined at the hip over here. Out of the 22 million contracts traded, right, you have 4.5 that have traded of the SPY. You have 1.2 million that traded in the SPX. But then, we could go look at the VIX, because the VIX is definitely part of the SPX and the spiders, because the VIX is the volatility index, okay? Almost everything that's trading out there today is in relation to the S&Ps. And here's the VIX, and this is a rather slow day, did 500,000 contracts pretty much out there. But again, you start to realize the magnitude of the SPX. So I'll go back to the SPX, and the single most important expected move the single most important expected move on a week-to-week basis is to look at the options, okay, for a Friday expiration. So let me take you back now to what ultimately happened last week and why this is so important. So last week, all right, and the way we actually draw this on the screen, and I'm going to kind of zoom in and zoom out for you. Last week, the week started right here. And here, as I'm kind of drawing on the screen, that line right there was right around 23.90. That's literally where the week began. The expected move, okay, into Friday was not too magnificent. It was plus 23 or minus 23. And again, that's $23 on a $2,390 product. So what did we do? Well, we started off the week on, Monday and Tuesday with a bang. The S&P's breaching to all-time highs over here of, 2405. Then all of a sudden on Wednesday, political ramifications, we came down. And this is one of the first times in a while we actually breached the lower end of the expected move. And I want to show you how much weight the expected move happens to hold. And to do that, I'm going to come into the SPX and we're going to look on an intraday, okay, just a 5-day chart. And you can pull up like 5 days, 20 minutes. Now, I left the after hours in here, neither here nor there, but I wanted to show you. Here happens to be, of course, the 23.90, okay? This is just ultimately breaking down. And if you look very carefully, okay, and this is, I'm zooming in specifically into Wednesday's trade, okay? This is, again, a 5-day, it's 20-minute candles. We actually touch the expected move, bounce off it, touch the expected move, finally rip through it. When we did rip through the expected move, it was spectacular in the S&P 500 E-mini futures contracts. The E-mini futures exploded in volume on that time frame. And again, you can actually look specifically into here. In fact, I have a drawing set. You can look at different S&P levels and so forth. Nevertheless, volume exploded inside of the S&P futures because, again, this is the hedging product. Okay, back over here to the SPX. Nevertheless, it only lasted, okay, a brief and kind of fleeting moment. We rallied back up into it Thursday, all right? And on Thursday evening, we were even talking about like, hey, we're very likely to close inside the expected move. Markets are not just going to sink off into the sunset over here. Lo and behold, we did in fact rally right back inside of that $23 expected move. So initially everybody goes, oh, okay, all the volatility is over. And that's what we're going to start to do now is rather than rehash like, hey, we had a big volatility movement. Okay, everybody saw it, right? It's over, it's done with. Got to be forward looking in the marketplace. All right. First and foremost, this is now the expected move for the next week. I draw the lines on the screen myself. The start for the week, it's where the SPX happens to be. The start for the week is right here. It's at 23.81 and change. Okay, 23.81. Now the expected move, and I'm going to show you exactly where I derive the expected move because I always do this on a Saturday morning. Just look at the chain. It's about $28.25, 26 cents. Okay, so the expected move is right around 28 bucks. All you have to do is literally take, okay, the closing price of the SPX, which is 23.81 and change, and what? Add 28 bucks and subtract 28 bucks, which, to the downside over here, this is about 23.53. To the upside, it's almost 24.10 on the button. All right. So this is the expectations. Now, the reason I'm mentioning this is the previous week, we were riding on about a $23 expected move plus or minus. Now we're actually riding on $28 expected move. One of the things that's really surprising to me is given the fact that we just saw some decent volatility, that the expected move in this coming week, it's really contracted. And at this point, like, I don't even care about like announcements coming out. For a long time, you'd look at a calendar and we'd go to the calendar and be like, okay, what are we coming out here? There's FOMC minutes coming out on Wednesday. Yeah, nobody apparently cares. There's, durable goods orders coming out, little bit of GDP. Nobody cares. Clearly nobody cares, because if they did care, there would be a heck of a lot more volatility packed in, all right? Again, markets have become like incredibly efficient. And what these expected moves do is they ultimately just handicap risk. It's buyers and sellers. This is not somebody turning up a dial going like, turn up the dial, there's more risk. It's just buyers and sellers. The reason the Friday expiration is the most important, it's the one that sees the most liquidity. And I always stress that, whatever sees the most liquidity. Now, here's the key point. So $28 expected move, done. Okay, are we going to stay inside of it? Possibly. Okay. Lately, we've seen inside the expected move in every recent week. We've been inside the expected move in every recent week. We've closed inside of it. This is one of the first times we've breached the expected move in a substantial period of time. We did have, again, a brief and fleeting moment back on March 21st. We breached it and popped back inside of it. The last time that we actually made a substantial move outside of an expectation is back here on December 7th of 2016. So every week thus far inside of 2017, we've been inside expectations. The one thing to point out, when we do crack the expected move, in every recent example, okay, and when I say every recent example, over the last 3 years, I went back and I actually looked at the data over the last 3 years. In every recent example we could find, when we cracked the expected move, we made a 3 standard deviation move. So think about this. There's a $28 expected move. If we were to crack through it, okay, you're actually looking at 3 times that, which almost becomes a $90 expected move at that point. That's 3 standard deviations. Pretty wild. Now, here's the question. What are the markets saying about this? So we rally back up, right? Everybody got it. Like, oh, okay, so we rallied back up over here. Yeah, we did. We rallied back up on the S&P futures, and it absolutely stuck out. But if you just looked at just these few candles, you're like, oh, that's the quintessential bear market rally. I'm sure somebody can make that argument. Okay, neither here nor there. We also rallied back up in the Nasdaq, but the Nasdaq had some more substantial damage done. And I want to take you into some of the tech stocks themselves. If you start looking at stocks like Microsoft, okay, Microsoft appears to be in a little bit of a downdraft prior to ultimately what? Wednesday's trade. Microsoft's in a little bit of a downdraft over there. Okay, so are we worried? Well, I don't know. What are the other massive market caps doing? Ironically, Facebook was also in a bit of a downdraft prior to ultimately Wednesday. Every ounce of it, though, was gained back on Thursday and Friday. That's important. Pretty much every ounce of it. Now, we gapped lower, okay, but we actually filled it in there. And again, I'm not into the gap trade at all. But Facebook was already ultimately in seeing some sell-side activity. Then we look at Apple. And again, all I'm doing is I'm looking at the core tech stocks that have been driving markets higher. You've had nothing but Microsoft, Facebook, Apple, Google, Amazon. That's it. Tesla's not a big market cap. Forget it. Netflix, forget it. Small market cap out there. Okay. We look at Apple. All right. Apple, it suffered a little bit on Wednesday. Bounced back. Hasn't completely filled up. Okay. But again, perspective, it's $3 off its all-time high. Okay, so Apple is kind of in between over there. Sure, Microsoft has actually been slipping. Sure, Facebook's been slipping. Apple, though, the behemoth, it's right on par. Again, one bad day. Google, okay, not only is Google not in a downdraft over here, but Google is within, again, striking distance on Monday morning of its all-time high. Similarly, Amazon is pretty much at striking distance of an all-time high. So we have a little bit of dissension, if you will, in the ranks. And I find this pretty interesting because the tech stocks are not telling us anything. We have Microsoft, okay, ultimately heading down. Facebook's heading down. Apple's relatively neutral. But Google and Amazon, they're all warm and fuzzy. And those two products, though, have really led us in the Nasdaq, okay, to ultimately all-time highs. So where do we go from there? And again, little perspective on the Nasdaq. The Nasdaq is still about 70 points off its all-time high. So a little damage was done. But again, this movement, it's like skinning your knee. Okay. So you can read into every chart that you want to over here. You're not going to find anything in the tech stocks. All right. Basically, you got 2 up, 2 down, 1 smack in the middle. How's that going to help us? It's a coin flip away from greatness. Here's an area that I think you should key into. The financials. Huge amount of order flow was ripping through the financials. Now, this is where some true damage was done. Okay, just a week ago, I'm crying over the fact that if the XLF, the financials, crack above 24, it's all over. That the S&Ps, again, what I was saying is if the financials crack above 24, the S&Ps were likely to go as high as 2450. Not only didn't that happen, but now we're looking at the XLF, and the XLF threatening the 23 level. In this coming week, okay, watch the XLF. It's been driving huge order flow into the S&P 500. If we crack under 23, that's pretty dire for the S&Ps. At that point, big time sell signal inside of the S&P 500. Again, huge amounts of order flow are driven in this product. So I looked over at the XLF, and I just looked at the 6-day options in here, and they are sitting on a 17% implied volatility, 44-cent expected move. That's nothing spectacular. However, the open interest in there is quite spectacular. Some big trade, though, throughout the course of the week inside of the XLF option chain out there. Nevertheless, what a difference a day truly made on a percentage basis. Financials got crushed. And if you didn't look at Goldman Sachs over here, it's where some serious damage was done. Again, back to the XLF, though, more importantly, the XLF cracking through 23, okay, where do you head from there? And the answer is down. I believe, though, if the XLF does actually crack the 23 level, this will be volatility exploding in the S&P 500. We're 35 cents off of it, which is actually on a percentage basis a decent sized move. Now, flipping gears over here, because everybody wants this answer like, again, was Wednesday a flash in the pan, and we're going to see some real volatility? All right, the VIX, forget about it. It's yesterday's news. And again, the VIX is not going to tell you anything. The VIX, it's again, what it is good and astute traders, okay, do not go into the SPX and start randomly buying puts because they need to mitigate risk. That's what the VIX records. The VIX is a measurement, okay, of intensity. It's a measurement of volatility in the SPX. Okay, by the time anybody goes into the SPX to hedge risk, everybody sees the risk already, right? So the VIX is not going to determine anything. Oh, it reverted back down to the mean. Neither here nor there. The one thing that really stood out to me and continues, and I'm going to pretty much leave you with this thought. If you want to know if the volatility is here to stay, if we're likely to see more volatility, the bonds, they say, oh yes. What do the bonds seem to know that the rest of us haven't figured out yet? Did you notice, okay, that the bonds, not only did they rally, and when bonds rally, what it means is institutional trade is duck and cover. It's a duck and cover position. It means get under your desk, put your helmet on, okay, start rocking back and forth over here. But the bonds exploded higher. Getting above the 152 range is pretty critical. And again, if you look at the longer duration chart, we just kept butting up against this 152 level. We finally breached through it. But the thing that really stood out to me the most is on Thursday and even Friday. And again, my mouse is literally on, all right? So here's Wednesday's trade right there. Here's ultimately Thursday and Friday trade. Why didn't the bonds sell back off? And I don't have an answer for you, okay? There isn't one. The notes as well. The notes are almost peaked out. They look like they're about to have just this huge breakout to the upside. If risk completely abated, the institutional world doesn't believe it. Think about that for a second, because to me, the most pivotal chart on here, if you're going to look at technicals and so forth, fine, but the most pivotal chart, it's not about, Facebook breaking down, okay? Even the XLF, It's about the fact that the bonds, okay, and the amount of liquidity in the bonds, stellar in the last couple of trading sessions. In fact, when you zoom out and you look at what Wednesday and Thursday trade over here, some of the largest volume we've seen in this bond product in the last, few years. And yet they don't back off when the market rallies. At this point, keep your helmet on, okay? It appears that the bonds are telling us that risk is still persisting. Sure, if you come in Monday, Tuesday, and the bonds sell back down to this 151 level, all right, put away the weapons and ammo, we'll be okay. But at this point, keep on your game. $28 expected move moving into this next week of trade over here, okay? Eyes obviously to technology. On Friday, tech was weak versus the S&Ps. So at this point in the game, we still perceive that there's a fairly large amount of risk out there. And if there's a product that everyone is gunning for, it's the Nasdaq. Thanks everybody for joining us here at TheoTrade for the weekend update. Have a wonderful weekend. Bye-bye.